how does an economy, you know, actively battling failing monsoons and totally erratic weather simultaneously manage to build a $15 billion AI hub?
And roll out fully programmable digital money at the exact same time.
Yeah, exactly. I mean, you look at the headlines for India in 2025 and 2026, and you are immediately struck by this wild paradox.
Right. It is a diagnostic landscape that is just incredibly complex.
It really is. So for everyone listening, imagine you are sitting down with us right now for an intensive, high-stakes exam prep session.
A deep dive into the absolute core of the machinery.
Yes. The syllabus today is the highly anticipated Chapter 1, Assessment and Prospects of the RBI Annual Report 2025-26.
And to ensure we get true conceptual clarity, we are going to cross-reference it heavily with the foundational text, the 00.RBIF&W document.
The functions and working document, right? Because our mission today is not just to memorize a bunch of statistics. We want to understand the actual mechanics of the Indian economy.
Yeah, that paradox you mentioned earlier is the perfect entry point. Because, you cannot take the pulse of an economy as massive as India's by just looking at top-line growth.
Right, you have to look under the hood.
Exactly. Our goal is to unpack the historical statutory mandates that actually force the central bank's hand, and look at how those century-old mandates interact with hypermodern things like artificial intelligence and tokenized assets.
We are going to dissect the reality of global trade friction and this quiet revolution in digital public infrastructure. So, okay, let's unpack this.
Let's do it.
Let's start with the macro picture, the theater this is all playing out in. Because the numbers for the global economy, they tell a very clear story of deceleration, don't they?
They do. It is undeniably a slowdown. Global economic growth managed to hold at about 3.4% in 2025.
But then the projection for 2026 just slides down to 3.1%.
Right. And context is everything here. That 3.1% is notably below the long-term average.
Which was around 3.7% between 2000 and 2019, right?
Exactly. The global engine is sputtering. And it is sputtering under the weight of several severe concurrent headwinds.
Like the massive supply chain realignments. I mean, we are seeing those driven primarily by high U.S. tariffs.
Yeah, when the world's largest economy fundamentally alters its trade posture, it just forces a total restructuring of global manufacturing and shipping routes.
Capital that would normally go into, productive investments is instead just being spent on rerouting supply chains to avoid tariff penalties.
Precisely. And then you add elevated policy uncertainty globally. Major economies are grappling with rising, increasingly unsustainable public debt levels.
And overarching all of that is the intense geopolitical friction. Most notably, the prolonged conflict in West Asia.
Which isn't just a political crisis, right? It is a direct threat to the Suez Canal, to global trade routes, and fundamentally to the price of crude oil.
Now, there were a few global tailwinds that kept that 2025 number from falling even further. We saw a massive surge in AI-related investments, propping up capital expenditure.
Right, and countries were aggressively front-loading their imports to get ahead of those impending tariffs.
Which created a temporary bump in trade activity. But, the structural trend is undeniably a slowdown. Which brings us to the anomaly.
India.
Yes. Against this backdrop of a fragmented, decelerating world, India remained the fastest-growing major economy.
Growth actually accelerated. It moved from 7.1% in the previous financial year to an estimated 7.6% for 2025-26.
The divergence is staggering. While much of the world grappled with those supply chain shocks and sticky services inflation, India's growth mechanism seemed fundamentally insulated.
And that insulation comes from the structural reality that India is primarily driven by robust domestic demand.
Right, rather than being a heavily export-led economy like China or Germany. And to really understand that insulation, I was looking through the RBI functions and working document. The history there is just fascinating.
Oh, absolutely. The F&W text really lays out the origins.
Yeah, the RBI's origins trace all the way back to 1926, to the Royal Commission on Indian Currency and Finance, usually referred to as the Hilton-Young Commission.
Right. They made the recommendation to completely separate the control of currency and credit from the central government.
And that specific recommendation is what culminated in the Reserve Bank of India Act of 1934.
Which is the absolute bedrock of modern Indian macroeconomics. The preamble to that 1974 Act states that the RBI's core objective is to regulate the issue of banknotes and the keeping of reserves.
With a view to securing monetary stability in India, right?
Exactly. And to generally operate the currency and credit system of the country to its advantage. That is not just bureaucratic language.
It's a statutory mandate.
Yes. Securing monetary stability is a legal duty to sustain confidence in the value of the country's money, regardless of external chaos.
So when global tariffs spike or shipping lanes are disrupted, the RBI's job, defined nearly a century ago, is to ensure the domestic credit system continues to function smoothly.
To protect that internal demand.
Okay, but I have to push back a little on this idea of total insulation. Let me look at the math here. We have this massive domestic demand, keeping the economy moving at 7.6%. But we aren't totally immune to the global slowdown, are we?
No, definitely not. Insulation is not isolation.
Right, because looking at the GDP component breakdown for 25-26, net exports still dragged our overall growth down by 0.1 percentage points.
Yeah, that is the mathematical reality of globalization. The Indian economy is deeply integrated into global supply chains, especially in things like services and refined petroleum.
So when global trade growth is projected to be a meager 2.8% for 2026, Indian exporters are basically fighting for a slice of a shrinking pie.
Exactly. That zero point 0.1 percentage point drag is the literal manifestation of those U.S. tariffs and West Asian supply chain bottlenecks hitting Indian order books.
Right.
But the key exam takeaway here is the concept of override. The sheer volume and velocity of internal consumption and capital investment were so powerful that they just effortlessly absorbed that external drag.
So let's think of it like a massive ship. We have this heavy domestic demand anchor that keeps us steady in a global hurricane of tariff wars.
That is a perfect analogy.
So let's pull up that anchor and see what it's made of. Let's dissect the domestic drivers. Private final consumption expenditure, which is just households buying goods and services, grew by a very strong 7.7%.
Which is everyday people spending money on cars, clothes, electronics, everything.
And then on the corporate and government side, gross fixed capital formation, representing physical investment in infrastructure and machinery, that grew by 7.1%.
Right. And when you look at the supply side to see who is actually producing those goods, the industrial sector posted remarkable numbers.
Yeah, real gross value added, or GVA, in manufacturing surged by an incredible 11.5%.
And this was not a statistical anomaly. This was driven by structural policy, specifically the Production-Linked Incentive, or PLI scheme.
Right, the PLI scheme fundamentally changes the incentive structure. Instead of just taxing imports, the government is directly subsidizing incremental sales from products manufactured domestically.
And the annual report notes that the PLI scheme attracted actual investments of over 2.2 lakh crore rupees.
Wow, 2.2 lakh crore. So we're talking about massive expansion. Basic metals, motor vehicles, advanced transport equipment. It transitions the economy from merely assembling to deep-tier component manufacturing.
Exactly. And acting as a parallel engine, the services sector remained highly buoyant, growing at 8.7%.
So booming manufacturing and robust services. But here's where it gets really interesting and brings us back to that initial paradox. We have a glaring vulnerability on the supply side.
The agriculture sector.
Yeah. Growth in real GVA for agriculture and allied sectors decelerated sharply, down to 2.4% in 25-26 from 4.2% the year prior.
And the culprit there is purely physical. We were talking about spatial and temporal variations in rainfall.
The lingering impact of El Niño severely damaged the Kharif crop yields. And this is where the F&W document introduces a major paradigm shift.
Right, because a 2.4% agricultural growth rate isn't just a problem for farmers anymore. The RBI now explicitly classifies this under the systemic theme of climate risk.
Historically, a central bank would just view a bad monsoon as a temporary supply shock. Right? You wait it out, prices stabilize next harvest.
But not anymore. The RBI's modern stance is that climate change poses a permanent, recurring threat to long-term macroeconomic stability.
It threatens growth, it threatens monetary stability, and vitally, it threatens the safety and soundness of regulated financial entities.
Because the transmission mechanism is so direct, crops fail due to erratic monsoons, agricultural incomes collapse, farmers default on their loans.
Non-performing assets spike at rural banks.
Yes. And suddenly a weather event has degraded the capital adequacy of the financial system. It transverses geographical boundaries entirely.
So because the RBI is statutorily mandated to maintain financial stability, they simply cannot ignore the weather.
No, they can't. In response, they created a dedicated division called the Sustainable Finance Group, or SFG.
And the SFG isn't just publishing research papers. They are actively running climate scenario stress tests on Indian banks.
Right, using a growth-at-risk framework to mathematically estimate the impact of financial vulnerabilities driven by severe climate outs.
They've rolled out guidelines for green deposits, mandated disclosure frameworks on climate risks, and forced banks to stress test their portfolios against climate scenarios.
It is a profound evolution. The central bank is essentially forcing commercial banks to price in the weather.
Which creates this incredible dual reality. On one hand, banks are stress testing against drought. On the other hand, the country's renewable energy capacity just crossed 250 gigawatts.
Ranking third globally.
Yeah. And electric vehicle sales surpassed 25 lakh units, heavily subsidized by the PM eDrive scheme. It is an economy straddling the agrarian past and the hyper-green future.
And you see that transition mirrored in the granular data of household savings. The annual report uses a metric called Gross National Disposable Income, or GNDI.
Right, which is the total income available to the nation for final consumption and saving.
Exactly. GDP plus net income from abroad plus net current transfers. And the data shows gross domestic savings rose to 34.2% of GNDI.
People are saving a massive portion of the national income. But the composition of those savings is what's fascinating. Net household financial saving increased to 7.0% of GNDI.
And the mechanism driving that increase wasn't a massive spike in gross savings, which actually moderated slightly to 11.8%.
Right. The increase in net savings happened because household financial liabilities plummeted.
Yes, the rate at which households were taking on debt fell sharply from 6.4% to 4.8% of GNDI.
Households hit the brakes on borrowing, paid down debt, and consolidated their balance sheets, building an incredible buffer of resilience.
Which is crucial because, as we established, climate shocks are dragging down agriculture. And that physical reality immediately triggers the most volatile tripwire in the entire Indian economy.
The price of food.
Exactly. And how the RBI manages that tripwire is the absolute core of their monetary policy operations.
Which brings us to the inflation equation. The data for 25-26 is remarkable. Headline inflation plummeted to 2.1%.
A massive drop from 4.6% the previous year.
The report attributes this plunge primarily to heavy food price deflation later in the year, as production recovered, combined with a major rationalization of GST rates in September 2025.
However, a purely surface-level reading of that 2.1% is dangerous. The RBI looks closely at the divergence between headline inflation and core inflation.
Core inflation strips out the highly volatile components of food and fuel, right?
Yeah.
To reveal underlying demand pressures.
Exactly. And while headline inflation dropped to 2.1%, core inflation actually experienced upward pressure.
Largely driven by a significant surge in the global prices of precious metals, particularly gold. So food got cheaper, but gold and core components got more expensive.
Right. And here's the policy decision that is a key exam takeaway. Despite headline inflation dropping all the way down to 2.1%, the Monetary Policy Committee, the MPC, held their April 2026 meeting and unanimously decided to keep the policy repo rate unchanged.
At 5.25%, maintaining a strictly neutral stance. Now, let me play devil's advocate here. If inflation is at 2.1%, which is incredibly low, almost touching the bottom of their tolerance band, why leave the repo rate at a restrictive 5.25%?
It seems counterintuitive, right? Like they are suffocating potential growth by being overly cautious.
Exactly. Why not cut rates?
To understand that pause, we have to look at the actual architecture of India's monetary policy, detailed in the F&W document. For decades, the RBI utilized a multiple indicator approach.
They looked at a vast dashboard. Money supply, credit expansion, exchange rates, interest rates.
Right. But the problem was that it lacked a clearly defined nominal anchor. Financial markets never knew exactly what the RBI was optimizing for, making inflation expectations very difficult to anchor.
Which eventually led to the Urjit Patel Committee in 2013, recommending a fundamental overhaul, culminating in a historic amendment to the RBI Act in May 2016.
Yes, the insertion of Section 45ZA, which formally adopted the Flexible Inflation Targeting, or FIT, framework.
Section 45ZA is the operational heart of the central bank today. It dictates that the government, in consultation with the RBI, determines an explicit inflation target in terms of the Consumer Price Index, CPI, once every 5 years.
The target was initially set at 4%, with a plus or minus 2% tolerance band.
And the F&W document dedicates a lot of space to a recent event, the second review of the FIT framework, between August 2025 and March 2026.
Because the first mandate ended in 2021, was rolled over and came up for review again. And the RBI didn't just quietly renew it, they initiated a massive public consultation process.
They went to stakeholders with 4 fundamental questions. First, should they target headline or core inflation? Second, is 4% still appropriate? Third, is the tolerance band adequate? And fourth, point targeting versus range targeting.
The outcome, published on March 25, 2026, was that the central government formally retained the 4% target with the same tolerance band, extending it out to March 2031.
But the crucial decision was explicitly choosing to keep headline CPI as the nominal anchor, completely rejecting the idea of switching to core inflation.
And the logic there is deeply rooted in the socioeconomic reality of India. In a developing economy, food and fuel constitute a massive, disproportionate percentage of household expenditure.
If the central bank only targets core inflation, ignoring the price of vegetables and cooking gas, they're ignoring the exact price changes that impact the vast majority of the population.
Precisely. If a monsoon fails and food prices spike, the average citizen's inflation expectations rise immediately. They demand higher wages, increasing corporate costs, which are passed to consumers, creating generalized core inflation.
The RBI has to anchor its policy to the reality of the consumer's actual basket. That makes perfect sense. But it still brings me back to the April 2026 MPC meeting.
The 5.25% repo rate.
Yes. The target is 4%, headline is 2.1%. Leaving the rate at 5.25% seems like steering a ship long after you've avoided the iceberg.
You have to factor in the mechanics of monetary policy lag. When the MPC adjusts the repo rate, the economic impact is not instantaneous.
Right. It takes months for that 5.25% to transmit through the commercial banking system, altering deposit and lending rates, and ultimately cooling or stimulating demand.
The MPC is legally mandated to achieve that 4% target on average over the duration of the business cycle. Not just react to a single month's deflationary print, they're looking 6 to 18 months ahead.
And when they look at the global horizon, the threat matrix is severe. The geopolitical conflict in West Asia is a direct threat to the Strait of Hormuz and global crude oil prices.
Exactly. India imports the vast majority of its crude oil. If tensions escalate and oil spikes, inflation is imported instantly into the Indian economy,
Driving up transport and manufacturing costs. So if the RBI were to cut rates today because food is temporarily cheap, they would be injecting massive liquidity just as an external oil shock hits.
It would violently reignite the very inflation they just spent years taming. Keeping the rate at 5.25% is a defensive posture.
It also protects broader financial stability. We saw what happened in the 2023 global banking crisis with Silicon Valley Bank. If central banks are forced to hike rates aggressively to fight sudden inflation, the value of older, lower-yield bonds plummets.
And if a bank experiences a flight of deposits and sells those bonds at a loss, it goes bankrupt. By maintaining a neutral, cautious stance, the RBI prevents the need for violent rate hikes later.
Protecting the balance sheets of Indian banks from those mark-to-market losses. The FIP framework requires them to be forward-looking.
Right. They secured the domestic inflation environment, but they're leaving their defenses up against the global hurricane.
Speaking of India's interaction with the global hurricane, let's look at the external sector, the balance sheet of how India trades with the world.
This is traditionally where fast-growing developing economies encounter existential crises.
Yes. Looking at the merchandise trade deficit for 25-26, the numbers are massive. The difference between the physical goods we export and import widened to $333.2 billion.
A significant jump from $282.5 billion the previous year.
We are structurally dependent on importing massive quantities of crude oil, electronics, heavy machinery.
By standard macroeconomic logic, a $333 billion physical deficit would signal an impending currency collapse. But you have to analyze the entire current account deficit, or CAD.
Right. Despite that colossal hole in merchandise trade, India's CAD was actually contained at a highly sustainable 1.0% of GDP.
The offset mechanisms are incredible.
It is like a family budget where they spend way too much money on imported cars and fuel. They should be bankrupt. But they avoid it because the kids are upstairs writing incredibly valuable software for foreign clients, and the uncle in Dubai keeps wiring massive amounts of cash home.
That is precisely how the Indian balance of payments functions. The deficit in physical goods was counterbalanced by a massive structural surplus in services trade.
India's IT and software exports remain globally dominant. And private transfer receipts, predominantly remittances from the global Indian diaspora, grew by a robust 10.1%.
India uses its human capital to finance its immense appetite for physical imports.
Now that covers the current account. But we also have to look at the capital account, the actual investment money flowing in and out, foreign direct investment, FDI, inflows, stood at $7.7 billion.
That's the sticky long-term money-building factories.
But foreign portfolio investment, FPIs, saw massive outflows of $16.5 billion, heavily concentrated in equities.
The hot money fleeing the stock market, reacting to global uncertainties. And the statutory responsibility for managing the extreme volatility of those capital flows falls entirely on the RBI.
The FNW document details their role as the manager of foreign exchange under the Foreign Exchange Management Act, FEMA, of 1999.
Their mandate is not to artificially fix the exchange rate, but to maintain orderly conditions and curb excessive volatility.
They monitor the NEAR, the nominal effective exchange rate, specifically a 40-currency NEAR, measuring the rupee against a weighted basket of major trading partners.
And during 25-26, that 40-currency NEAR depreciated by 6.9%.
Which is often misinterpreted as a failure, right?
Exactly. It is not a failure. Depreciation is a necessary macroeconomic shock absorber. It reflects differentials in inflation and interest rates.
If the RBI tried to fight that depreciation by aggressively selling dollar reserves, they would drain domestic liquidity and distort the credit system.
Right. Their job is to ensure the depreciation happens smoothly. When $16.5 billion of hot money exits, they deploy foreign exchange reserves to provide dollar liquidity, ensuring the rupee doesn't experience a violent crash. They manage the descent.
Okay, we've discussed traditional mechanisms at length, but what is truly staggering about this annual report is that it shows the RBI is actively architecting the digital infrastructure of the future.
The fintech, AI, and evolution of money sections are unprecedented. The Reserve Bank has transitioned into a pioneer of digital public infrastructure.
The most consequential manifestation being the central bank digital currency, the CBDC. They massively expanded pilots in 25-26.
But they aren't just creating a digital version of a paper rupee. The absolute game changer is programmability.
Right. The retail CBDC, e-rupee retail, introduced programmability targeted at direct benefit transfers, DBTs.
Because in a traditional DBT system, once cash hits a beneficiary's account, it is fungible. The government has no visibility on how it's spent.
But programmable CBDC changes the physics of currency. The government can embed restrictive logic directly into the token.
The real-world examples are mind-bending. Pilots in Gujarat, Puducherry, and Chandigarh involved the public distribution system, the PDS.
Food subsidies were credited as programmable tokens that could only be redeemed for eligible commodities at specific fair price shops.
If the beneficiary tried to buy electronics or alcohol, the transaction would instantly fail. The money refuses to function outside its programmed parameters,
Creating a closed-loop system that theoretically eradicates leakage. And on the institutional side, the wholesale CBDC pilot leveraged the Unified Markets Interface, UMI.
Designed to completely tokenize financial assets, they initiated a pilot to tokenize certificates of deposit. Settling trades of tokenized CDs using wholesale CBDC bypasses traditional clearinghouses, enhancing velocity and mathematically reducing counterparty risk to zero.
The intelligence managing all this is artificial intelligence. The report highlights massive AI capital expenditure. Google building a $15 billion AI hub in Vishakhapatnam. Tata constructing an $11 billion AI city in Maharashtra.
And the RBI is building its own institution-grade AI platform, scaling up tools like NewHunter.ai to autonomously track behavioral patterns and detect money mule accounts.
Which stems from their long history of institution building. Setting up NPCI for UPI, Rebit for cybersecurity, and the Reserve Bank Innovation Hub, RBIH, in 2021.
And RBIH incubated the Unified Lending Interface, ULI, designed to do for lending what UPI did for payments.
Right, destroying the massive friction in traditional lending. A digital architecture providing open APIs connecting data providers directly to lenders.
Allowing a bank to instantly ping land records, GSTN datasets, even satellite imagery of crop yields to algorithmically approve credit in minutes.
But wait, I have to pause here. Looking at the ULI and programmable CBDCs raises huge questions about privacy. If the ULI connects all my data and the CBDC allows the government to issue currency with strict rules on what I can buy, aren't we stepping into an unprecedented level of financial surveillance?
That tension is the defining ethical battleground of the digital age. The RBI is acutely aware of the immense power of this architecture.
You're substituting fundamental financial privacy for systemic efficiency.
Yes, weighing systemic benefits against the right to privacy. And they regulate this through intensely monitored experimentation in regulatory sandboxes, testing in ring-fenced environments, monitoring vulnerabilities and behavioral impact before rolling it out.
It is a phenomenal balancing act. We started looking at a 7.6% growth rate. and ended up dissecting programmable code. Macroeconomics is a constantly evolving machine.
An interconnected system where a climate shock to agriculture forces an inflation-targeting decision, interacting with global capital flows, while the plumbing of currency is rewritten.
Which leaves us with a final fascinating concept for you, the listener, to mull over. We discussed how traditional monetary policy operates with a severe lag, taking months for a repo rate cut to transmit. But if the ULI removes credit friction and programmable CDDCs reside in every digital wallet, how does that alter the physics of central banking?
The implications are profound. The agonizing lag of monetary policy transmission could theoretically be reduced to zero.
Exactly. Imagine the MPC announces a rate cut, and instantly, the programmable logic in your digital wallet updates. The incentive structure of the economy shifts in seconds, instantly countering an external shock. We're no longer steering a heavy ship, we are driving a high-performance digital machine that reacts instantly to the road. It completely redefines what an economy is capable of. It's an incredible evolution to witness, and understanding the mechanics behind it changes how you see every headline.